Good afternoon. Welcome to today's webinar on tax breaks for fabricators, what you need to know. Sigmatek and Alliant Group are pleased to be partnering to bring you this session. Today's webinar will be recorded and a link to the webinar will be sent to you following the presentation. Please share the information with other members of your team. If you have questions during today's meeting, please use the questions box to the right of your screen and we will be sure to answer them as the webinar progresses. We will also be taking questions after the webinar, so please be sure to, if you have questions, keep typing them in. With us today is Bill Huffman from Sigmatek. He's been with Sigmatek for 22 years, and the last 15 has served as Director of Corporate Accounts and currently runs our Seattle office. Presenting will be Greg Canard from Alliant Group. He joined Alliant Group 8 years ago as a Director for the Midwest region. He's an expert on R&D tax credit and working with companies to strengthen their business. Thank you for joining us. And Greg, let's start.
Well, thank you very much. It's a pleasure to be here and really love the opportunity to speak with a variety of metal fabricators on how they might be able to save tax dollars. I know especially this time of year, it's really meaningful, right? We're going through probably finalizing your corporate tax returns, and then you're contemplating filing for your April 15th. And so what's our taxes look like? And everybody's looking out for all the different tax benefits that might avail them. So let's get started talking about this. So number one, here I am. As was said, my name's Greg Canard. I've been working with the Alliant Group for 8 years. I lead the Midwest practice at Alliant Group, work with a lot of firms across the country. I do a lot of national speaking at conferences. I've been working with the R&D credit for over 20 years. And I think what you would find with the credit and what we're really going to be focused on today and the discussion surrounding its applicability to companies like yours is how things that you do every day might qualify for this incentive. So I'm really excited to be here. Bill, I know I'm going to go to you. I have your slide. I don't know if you want to say a few words before we jump into this, but thought I'd give you a quick opportunity here.
Sure. Thanks very much, Greg. And again, welcome everybody. We're really pleased to be able to bring this kind of information. As Greg said, this is so important to all of our customers, but also some of those small customers that maybe don't have the depth in their tax review to even realize that this is a benefit for you. So I'm really excited. I'm sure you are too. So Greg, gosh, you're...
Yeah. So here's what I would say. And as we go through this webinar today, we want to make it interactive. So of course, please ask questions. We want to make sure that you get a really good understanding of what is this opportunity, what's it look like, and ultimately how would it benefit a company like yours. So at the end, we're going to go through some case studies in terms of real world examples. Now, Bill, I have asked him to interrupt me with questions that you guys may have along the way to better drive home the opportunities for you guys to claim this incentive. So along the way, hopefully this is a little bit more like a conversation surrounding this topic. We start talking about tax, it gets pretty boring pretty quickly. So we'll try to make it as fun and as entertaining as we possibly can. So let me give you some reference or framing of our firm, because I think it's important. What I tell you may be a fundamental shift in how you construe what research and development is, or more aptly put, what qualified research is. So our firm, like we said, I come from a firm called Alliant Group. We are a national tax advisory firm. We as a firm are close to 900 folks. We are led by a variety of different people. And so here's, from our leadership team perspective, I just want to give you a sense of kind of the people that are on your team when you really look to claim this credit. So a couple of people I want to point out, if you look at the second row, sort of fourth person over, a gentleman by the name of Mark Everson. Mark was former commissioner of the Internal Revenue Service from 2003 to 2007. He was appointed by President Bush. was commissioner of that time. So it's important that we understand that the relationship that we have with the Internal Revenue Service in understanding what their expectations are in terms of documenting these incentives is really, really important. So again, when we think about this incentive, it is going to be a shift in how you view research and development. So I want you to make sure we all are understanding this isn't setting up a bank account in the Cayman Islands to try to avoid tax. Also, Steve Miller was former acting commissioner of the service after Doug Shulman left the service. So in total, we have 3 former IRS commissioners. We have in our Washington, D.C. office, we have people that have worked in as senior tax counsel to the Senate Finance Committee, which is the Finance Committee is the tax writing authority in the Senate side. So we have a really unique perspective in terms of what the congressional intent of this incentive is, what the IRS allows, and ultimately what we can prove. And so that's important, right? How do we prove and document, and who does that? So when we think about the opportunities that we've brought to the industry as a whole, we found more than $7 billion in government incentives for our clients. We work with more than 4,000 CPA firms nationally. So I want you to please understand, when Bill and Sigmatek asked me to talk today, this wasn't in an effort to replace the function of your CPA firm, right? So this is a unique perspective. We, in fact, work with over 4,000 CPA firms nationally. Think of your relationship with your CPA firm as like that of a family doctor. We would be more akin, I think, echoing Bill's comments, taking a deeper dive in this, we would be sort of akin to an orthopedic surgeon if you hurt your knee. So, again, that's kind of the context of it. Now, the folks that we have, and this is the last slide, and we'll get into the heart of the R&D credit. I talked about the former commissioners we have, former counsels to the Senate Finance Committee, but we also on staff have architects, engineers, software developers, chemists, biologists, statisticians, CPAs, attorneys, all working in unison to help maximize these incentives for our clients. So again, when we work with metal fabricators, and we've done a lot of work in this space, it's engineers that are teasing out this information that is necessary to claim this incentive. Okay, so without further ado, let's talk about the R&D credit. We're going to talk about what it is. We're going to dispel some of the rumors. We're going to talk about the benefit, like what's this mean if we do have qualified research taking place. And so we'll dig into this. Again, Bill, as you have questions, let me know, okay? So when we think about the R&D credit, okay, Congress really instituted the credit in 1981. It was part of really a push from Ronald Reagan. There was this sense that we were at a competitive disadvantage as a country with companies that were operating in Southeast Asia and in Europe. And so just to let you know, tax legislation, tax law, obviously taxes are intended to raise revenue for a government, right? That's what it's intended to do. So it can fund certain things. But tax policy is also driven to incent behavior and dissuade behavior, right? And so that's why they have a home mortgage deduction. They want people to buy houses, and that's why they tax certain things that they don't want people to do, like cigarettes are taxed so high, right? So it's this balance of trying to shape behavior. And so they said, well, we want to reward certain activities, certain investments, we want to promote these activities. And how do we do that? And they chose to do this through a tax credit. So we've seen an evolution of this credit from when it was first instituted. And the thing that I battle every single day as a professional working in this area of tax law is the perception that to qualify for the R&D credit, I have to have people with lab coats, beakers, and test tubes walking around, right? I have to have PhDs. That is not true. That is not true. That the R&D credit if you think about this, is a reward from the government for trying to make things faster, better, or cheaper. That's what it is. It's to promote economic development. It's to make U.S. businesses more competitive, right? And stimulate U.S. manufacturing, construction, engineering, those types of industries. That's what it is. So there's been a lot of misunderstanding related to the definitions. Part of it is, quite frankly, the fault of the Internal Revenue Service, but we're going to talk about some of the changes and why companies qualify. Now, the R&D credit, let's have just a 2-second accounting class or tax class. R&D credits or tax credits are different than tax deductions. I'm sure you probably all know this, but it just bears repeating. Deductions reduce taxable income, and that taxable income is then multiplied by your tax rates. And we have a graduated schedule of tax rates for individuals. A tax credit is a dollar-for-dollar reduction of tax. So if I have a $50,000 tax bill and I have a $25,000 tax credit, now I only owe $25,000 worth of tax. Okay? Now, also, when we think about R&D activities in your organization, don't just think about what you're doing in 2019 or maybe even what you did in 2018. But I want you to think about activities maybe going back as far as 2015, because there is opportunities to take advantage of these credits to amend tax returns and to generate refunds. Okay? So just think about that. If you find that what I explain is R&D that you guys are doing, or the companies here in attendance are doing, you might find that there's not a 1-year benefit, but perhaps a benefit of 4 years. Okay? And so if you can't use credits in 1 year, you can carry them back 1 year or forward 20 years. And then also, so it's not a use it or lose it, as I put in my slide. Also, depending on what state you operate in, there's several states. The majority of states have R&D tax credits. So if you have specific questions about, hey, does my state have an R&D credit? Let me know. I'm happy to answer those. Okay. We good so far, Bill?
Yeah, I did have a quick question about that carrying forward 20 years. So does that mean that I can apply and receive a credit and then decide when I want to apply that credit?
Yeah, that's a really good question. Yeah, I think we always look at utilization, right? And utilization meaning, when I use that term, what I'm effectively saying is, of the credits that I do qualify for, what's my ability to convert those credits to cash or tax savings, right? So it's not a decision that is made by taxpayers, Bill. It's more a decision that is made by law and math. So if, let's say, I had 2018 tax credits, but I didn't, for some reason, I was in a net operating loss in 2018 and I didn't pay any tax, then I can't say, I'm not going to carry it back to 2017. I'm only going to carry it forward to offset future tax. I am required by law to first reduce my tax in 2017, and then any unused balance would then get carried forward for up to 20 years.
Got it. Okay, now, that makes a lot more sense.
Yeah. And so states also have different rules surrounding that. Some states you can go back and amend tax returns and get refunds. Other states you can't. So it's going to be case by case from a state perspective. So, okay. And again, thank you for the question. And again, interrupt me. Like I said, it's much more fun when we have these kinds of back and forth. So, you bet. All right, let's get into the definition of what is research and development, because I think this is really important to understand the concept from the basis of what the government's trying to reward here and why are they trying to reward this. So the first criteria that we talk about with the R&D credit is that we're attempting to discover information based in the hard sciences. It actually says based on principles of the hard sciences. But The intent congressionally, so you think about people in Washington writing this and going, okay, how do we write this? And they said, well, the first thing we want to do is eliminate soft sciences from consideration. So we don't want companies being able to claim an R&D credit for studying the arts and humanities or sociology. We want things based in manufacturing, engineering, construction, the types of things that we said. Okay, so Congress writes code. They write the law that the president signed that becomes law. And then the Treasury Department and the Internal Revenue Service write regulations. And so those regulations are simply their interpretation of the code. Now, I'm not telling you this to give you a history lesson, but the reason I'm telling you this is because this still is a prevailing thought, even with metal fabricators, on why they don't qualify. Because the perception and in the temporary regulations for the credit from 1981 to about 2001 was not only does it have to be based in the hard sciences, but notice I used the term discover. And the IRS said, we interpret the word discover to mean you're discovering something new to the world, revolutionary or patentable. So if you think about your company, are metal fabricators doing things new to the world? So I'm not going out in a limb to say probably not. The only companies that were really claiming the credit under this regime were pharmaceutical companies and companies like Apple and Microsoft and software companies and things like that. So what they did, and the government said, well, this credit's not being used the way we want it to. And so they didn't ever provide permanent regulations for the credit until 2001. And what they did was they scrapped this test, because if you say, well, the information I'm discovering, if it's got to be based in the hard sciences, which metal fabrication clearly is, without a doubt, manufacturing clearly is, the information we're discovering doesn't have to be new to the world. It doesn't even have to be new to your industry. It just has to be new to us. So anytime a customer comes to you with a drawing, a sketch, a part, and we're trying to determine, have we done this before? And when I say this, I mean exactly that. Have we made those? How do we hold these tolerances? What materials do we use? How are we going to weld these? You may look at things like constructability or manufacturability of parts. So you may be given a drawing and you say, you know, if you actually manipulated it this way or changed the design slightly, it would be more repeatable. It's those types of things. Or it may be questions as you leverage Bill and his company with, how do we improve our technology? How do we integrate this technology into our business? How do we try to make things faster, cheaper, better? How do we reduce scrap? How do we increase quality that is inherent in that may also be eligible for the credit? Okay, so it's not just the products, but the process. Okay, that
so
just has to be. Go ahead, Bill. No, please.
Yeah, sorry to interrupt, but yeah, so it sounds to me like this is really something where I'm improving my process. I'm improving how my company brings something to the market. And that process of research and development to make sure that that is an improvement over what I'm, not the industry like you said, but what I'm doing, that's really something that we can apply to the R&D tax credit.
That's exactly right. That's exactly right. And let me sort of round out why this qualifies or how it qualifies. So when we think about the credit, so that's the first thing. We have to be attempting to discover information based in the hard sciences, and it just has to be new to us, okay? Also, we have to be attempting to develop a business component, okay? And I'll talk a little bit later about this just briefly, but a business component is going to be a product, right? So, and often fabricators, contract manufacturers will say to me, Greg, I don't design the part, so I'm not. But you don't have to design the part in order to be eligible for the credit, because you're designing the process. So you may not, you may get, here's what we want it to look like, now make it, right? And we have to figure all that out. That's what is the eligible part of this, right? It also is techniques, inventions, it's software, it's formulation, it's all these different things when we think about the credit. Also, there has to be some uncertainty related to the project. Okay? Now, when we think about uncertainty, it's not uncertainty related to your capability, meaning a customer coming to you with a drawing or a part. Can you guys make this? I would argue that probably in most cases, you're confident you can do this, right? I know we can do it, but it's not uncertainty related to capability. Okay? I know I can make one of these. It's uncertainty related to what's the best way to do it? What's the cheapest, or what's the most efficient, or what equipment am I going to use on this? Or how am I going to organize my manufacturing process to optimize the efficiencies that I have there for optimal product flow? Right? So you have uncertainty on a number of different levels, not related to can I do it, but how do I do it? Okay. And then lastly, we have to attempt to overcome that uncertainty by evaluating different alternatives. The evaluation of alternatives can be through physical experimentation. So what's an example of physical experimentation? Well, it's prototypes or samples, or maybe if you're building completely custom units, it's that one custom unit you're building that's eligible for the credit. Okay? But I also want you to understand it's not only physical experimentation. It's also the theoretical or conceptual evaluation. So the question is, well, what's that look like? Well, I want you to think, what happens when you get a request for quote? And so we have our sales personnel, or we have people in estimating, or we have our engineering department, and we don't have to have degreed engineers to be eligible for the credit, but the sort of air quote engineering department that is determining, okay, how would we do this? What would this look like? What would our router be for this? How much do we think this would cost? And you contemplate the entire production of it conceptually, just in order to determine how much is this thing going to cost. And so you issue a quote. Well, how many times do you guys in a situation where you never hear back from that person? The job doesn't go anywhere, right? You never get a purchase order. Those activities are still eligible for the credit. Okay? So that quoting, that sunk cost that we have in that quoting process is going to be an area that you may find has additional eligibility. So that's the criteria, everyone. Yeah.
That's really interesting. So as a company says, I've identified something that I've not attained the efficiency that I want. And so they bring someone in to take a look at that function that they say, look, it's not where I want to be, but I don't necessarily have an R&D department, or maybe even people capable of doing that. If they bring out, or if they bring in an outside consultant to examine that and stuff, to determine if we can make an increase in efficiency and stuff like that, does that then qualify them for the R&D tax credit?
Yeah, it absolutely can. So everybody, that wasn't a planted question at all. None of these are, but that's a brilliant segue, Bill. So thank you very much about what types of costs qualify. Wow, that's perfect. So yes, yeah. So there's three basic costs that we can include related to the R&D credit. So let's work in reverse order. I'm bringing someone in. Here's how this is often manifested. And I want you to think about I don't want you to think about new product, new programs that we're bringing on. But what happens when you guys have been making a part, maybe in a high volume, from a high volume perspective or a higher volume perspective, and the customer comes to you and says, we need a price reduction. We need a 3% price reduction, or maybe that's agreed to when you take on a program. And so there's only so much you can wring out in terms of raw materials, that you just have to look at how do we try to make this faster, cheaper, better, more efficiently. And so, Bill, that's right on, right? That to the extent you're involved in those types of contemplations, those types of exercises, so some of the work that even Bill, you guys are doing absolutely could fall within this category. Things like lean manufacturing or adopting lean manufacturing techniques. can qualify. Any efficiencies we're trying to build into that are going to be things that are going to fit in this or should be evaluated to determine if they're eligible. Okay. We also can include supplies. So I'm working in reverse order. Supplies that we consume are things like samples, prototypes, first articles, right? Those are all good examples. Also in endeavors in which we're developing, larger prototype units, those units can also be eligible, even perhaps if you're selling them to the customer. So a lot of first articles are sold to the customer that are fit within this, and I'm going to tell you why that is. And then lastly, which I normally start off my conversation related to expenditures with wages, but wages are typically the driver for companies, meaning they're going to be the largest amount. So with wages, we can include people that are engaged in qualified research. So I want you to think within your respective company, what is that technical epicenter, right? Where is that at? So typically that's going to be an engineering department. It may be the head of operations. It may be the owner of the company, right? You may be driving from a technological perspective. And so we can include those people. And essentially what an R&D credit is comprised of, to take it appropriately, is comprised of contemplating the qualitative documentation. How do projects qualify for the credit, with the quantitative amounts? So we're going to be allowed to include a portion of people's Box 1 W-2 wages of people doing the research, but also supervising those activities is also eligible. And then also eligible are people supporting those activities. So I just talked about sales a few minutes ago, or estimating or quoting that we go through, that is working with those requests for quotes from the customer. But it ends, and I'm going to talk to you today about, or for this example, from a product development standpoint, where a customer comes to us with a part or an opportunity, and that project is going to end when we're in commercial production. So commercial production isn't the first time we make something or the first time we sell something, but it's that time in which the customer says, that's what I want, and we're done, right, in terms of claiming credits. So who's involved? Well, you tell me who's involved. So it's people in manufacturing, tooling, quality control, right? All these different people are going to have parts of their time that are going to be eligible. So it's not just the 1 or 2 or 3 or 10 engineers you have that are eligible, but it's going to be a whole variety of different folks from this process of starting the project to finishing the project. Okay? Now, for every dollar we spend for 2018, we're roughly going to get 8% of that dollar back in the form of a tax credit. Okay? So if you spent $300,000 in expenditures, and it's going to be a function of your wages and supplies and contract costs, you'd have about a $25,000 tax credit, okay, which is going to offset $25,000 worth of tax. But that $25,000 incentive for 2018, if we look at 15, 16, 17, well, now you may have $100,000 in refunds or tax savings. So this can get pretty large pretty quickly. And so I would argue, well, that's awesome. Everybody loves getting refunds. Everybody thinks that's amazing. We can reinvest in the company, or quite frankly, do whatever you want with the refunds. And so that's good. And I would argue on some level that may promote economic development. But I will tell you, that's not what the federal government's after. They're not after companies after the fact getting refunds. They're okay with it. It's fine. And it's absolutely allowable. But I think from the perspective of your company is what happens in this ultra competitive world that you operate. What happens if I know 8% of the cost I have in developing this new program, I'm actually going to get back in the form of a credit? How does that impact the way I price projects? How does that impact when I make a hiring decision? When does that impact when I decide to purchase a new piece of equipment? And so all those things, and you think, and I told you I'd give you sort of what's the payoff for the government? Well, for you business owners on the phone, they're willing to forego the tax you pay personally. All right, so if John Doe is getting a $30,000 refund every year, they're okay with that, in the hopes that in making our products more competitively, that our company grows, that we hire more people in these industries, that those people pay taxes, those people have families, those people buy houses, those people, and the creation of the job at your level promotes economic development and job creation, supporting that job in other areas. And it's that repeating 30, 40,000 times annually in the U.S. that is really what promotes and stimulates economic development. That's what they're after. Okay? All right. So if I had to distill down, trying to pick out whether or not your company qualifies for the credit, I would probably use a slide like this, but it bears some explanation. So let me explain what I'm after here. So we talked about business components. So we had to be attempting to develop a business component. So number one, I want you to forget about where these check marks are. These are just for illustrative purposes. However, look at the left side where it says projects business component. So if we're working on a product or a process or a software or a technique or a design, right? So that's down the left. And if we're trying to, in any point, trying to increase the function, the performance, the reliability, the quality, the durability, if we can check a box and we're trying to increase the quality of a product, so we've done that, then I would say you have a high likelihood of being eligible for the credit, that this is a relevant topic. Okay? So if you can check them, if you can go through that and say, well, from a process standpoint, we try to increase the performance of a process, and we've increased the functionality of products or manufacturing processes. Any of these things are going to be things that would fit nicely into being able to claim the credit. Okay? So let's talk about, we've talked about a lot about theory and a lot about law, and that gets a little bit dry. So let's talk about actual activities that we see in your space for fabricators. So hopefully I didn't skip ahead one. So here's some examples of qualifying activities for fabrication companies, fabrication firms. So custom fabrication, I would say custom fabrication with a period, but if we're doing pressure vessels, SME work, or working to client specifications, great example. On-site fabrication, we're doing design assist activities. And we talk about pressure vessels, but it's not just for pressure vessels. Please keep that in mind. We're just giving some more concrete examples. On-site and shop quality assurance testing, developing unique welding techniques. If we're doing specification review and concept development, or quoting, estimating, we're looking at facility design. We're looking at part design for manufacturability. So this is to give you an idea of things that could fit in this category. So there's a lot more too. There's just a lot more here. So how does this impact you guys? Well, like I said, you can get money back in your pockets, right? There's opportunities to get refunds, to put money back in your pockets, to advance your company, to be more competitive, to hire people, to take on new CapEx expenditures. Okay, those are all good things, but also to attract and retain talent, right? How do we, as you guys have seen, and if you're like many of my clients that I work with across the country, labor is really tough. It's very competitive. It's hard to fill positions. We have more work than we have people. And so how do we optimize and become more efficient So it's about attracting and retaining talent, again, investing in new equipment or software or machinery. The payoff is staying competitive, because what happens is, when we get in this environment in which, and there have been a lot of changes to the credit, I'm going to talk about why maybe we haven't taken advantage of this or what's changed. But what you really need to look at is, in order to level the playing field from a global perspective, which is really important, right? You guys are competing with companies globally, companies that operate in Southeast Asia that have much lower labor rates, companies in Mexico, everywhere, right? So that's important, right? To essentially get subsidized in some ways, but also even domestically, if you're up against a competitor that is factoring this R&D credit into their pricing models, they've got an 8% cushion in some cases, and it puts you at a competitive disadvantage. So again, that's why it's just so important to prompt and promote that continued innovation. All right. Okay, so let's talk about.
Sorry.
Yeah.
Greg, I'm sorry. I did have a quick question, relating to the stuff that we just talked about. Sigmatek has a program where we'll go out and we'll do a discovery. And these discoveries are meant to uncover, a lot of what you're saying. It's trying to innovate a process. It's trying to improve a process. They kind of come to loggerheads. They can't get beyond this point, but they want to bring in a consultant that actually does this kind of planning and this kind of research for them. So when we do that discovery, we go on site. We're at the customer's facility. We're looking at their process, stuff like that. Does that kind of a program, does that fall within the R&D tax credit? Because they're not performing that R&D themselves, but they're having it done, and it's a paid process that owe and work through. Is that part of the R&D tax credit?
Yeah, I think that can be part of the R&D tax credit. It's definitely part of the equation. It's part of things that as you look at using Bill and his firm for doing this type of work, those are things that fit pretty nicely within the context of the R&D credit. I think it does on a couple of different levels. Perhaps the payments that you pay to Bill's company, right, Sigmatek, that you pay for those things can potentially be eligible for the credit. But also I would look at the time investment that you're spending talking with the folks there, that you're doing this, you're involved in this discovery phase, that you're really contemplating and reviewing how you can jump to the next level from whether it be an innovation or a competitive or a pricing model or a growth model. Those are all different ways that absolutely can be eligible. And again, it's this pretty radical departure, Bill, from this concept of, well, we have to have lab coats and beakers and test tubes, and we can only work on internally initiated projects that we're not getting paid for that are eligible. It's not, it is that, but it's also much more than that. The majority of the clients that we work with that are engaging in the process of claiming the R&D credit, it's much more about customers pushing, demanding, requiring them to be more competitive, to bring solutions, this concept of concurrent engineering, and the whole concept of, well, I don't have a degreed engineer. Well, that's okay. And that's okay. You're not stamping drawings and you're not assuming any product liability for certain things. That's okay too. That's not what this credit's intended primarily to reward. Again, it's to make companies that are on this webinar, and I've seen the attendees on this webinar, I have no doubt, it's to make your companies more competitive, period. That's what it is. And so leveraging Bill and his firm only could fuel and promote the creation of that credit. Okay. So
I'm sorry, Greg, one more.
Please. Sure.
Thanks. So in the explanation, the previous couple slides, we're talking about how we present the proof or the data of our discoveries or of our internal R&D activities to include labor, stuff like that. I'm wondering about the kind of requirements for documentation on that. You know, some of our smaller customers, even some of our larger customers, they may not have, you know, a research and development group that could document this. Is there any specification on the kind of documentation that's necessary to apply for the R&D tax credit?
Yeah, that's a good question. So there is, and so I would say in reviewing most of the attendees on the webinar today, they probably don't have R&D departments. They probably don't. I would say most of them, if not all of them, have, you know, an R&D group at their facility. They probably have an engineering group. They don't have an R&D group. And so the question becomes, okay, how? Okay, this sounds great, but how? What? Why? How do we do this? And so the R&D credit is documented from two different perspectives. One is the qualitative documentation. So our firm, saying we've done over 34,000 of these studies, that's effectively what we do, is we help companies document these activities, right? And also assign a value to these activities. So what portion of wages, what portion of supplies, what contract research costs, what are the projects, how are they eligible? The first thing taxpayers will think is, well, everybody's got to have a stopwatch and they have to be tracking time to individual projects. And I say, that isn't the case. That's not true. There are ways that are IRS approved methodologies to capture that. But here's what you can't do, Bill. What you can't do is you can't swag a number, right? You can't make estimations and say, well, here's my labor and here's my supplies and here's my contract costs, and give that to your accountant and have them put on their return. Now that'll go, right? You can file that way, but a couple of things happen. You have a tremendous amount of exposure, right? Because when the IRS audits these, their perception of clients that claim, or taxpayers that claim this credit, is that you've contemplated this 4-part test and how it's reconciled with this. So contract manufacturers literally have thousands of projects every year. We don't look at every project. We statistically sample those projects and we'll review a handful, but it's through approved revenue procedures to do that. So any sort of, hey, I think it's 25% of the time I do this, and probably Larry over here is spending 60% of his time, and the math will get to a point where it'll work out. A credit will be derived, but you're opening yourself up to a massive amount of exposure, penalties, interest, if this is ever audited, because that level will just not withstand any sort of scrutiny, right? It just won't. And so it's really important to document these types of activities in order to properly substantiate this. When you properly substantiate it, by the way, your credits are most likely significantly higher, just because everything's sort of vetted through and gone through. Okay, so I'm going to jump to the next slide to talk about what's new with the credit. What's new? So I don't know the familiarity individually with people, but I've said I've been doing this for 20 years. There have been a massive amount of changes related to the credit as we've looked at it over the past 3 or 4 years. So the first one sounds really fancy, ASC on amended return. What does that mean? Well, there's a new calculation methodology, relatively new calculation methodology, that has allowed companies to have an easier time claiming the credit. That if you're familiar with the credit at all, one of the difficulties with the R&D credit has been that for some companies, you had to go back as far back as 1984 to 88 and reconstruct and model what we were doing in that time period, which made it almost impossible. And we can do it, and there's certain tools we can get at to do it. But they also have implemented the new ASC method that you just look at the prior 3 years in order to compute and calculate the credit. So again, in an effort to make it easier for smaller businesses to claim and take advantage of the credit. The granddaddy as it relates to R&D credits is the PATH Act of 2015 that was signed. So effective 2016 and forward, there have been really a couple of major changes to the credits. Okay, number one, it's permanent. Well, the R&D credit's been around. You said, Greg, it's been around since 81. You're saying it hasn't been permanent. Not by law, it hasn't. It's been subject to those 1 and 2 year extensions throughout the course of its life, right? But in December of 2015, it was made permanent. So it doesn't take an act of Congress to, in effect, renew the R&D credit. And so that's important. I'll give you that. That's important because we like permanency in the tax code. But the big thing for companies on this call today, the massive thing. So if you've looked at this credit before and for whatever reason your CPA said not going to work for you, it's probably related to the second part of this, and that is this, what we refer to as the AMT turnoff. So I'll explain it briefly. The alternative minimum tax, typically if I'm a pass-through entity, so an S Corp, an LLC, a partnership, and I am taxed at the individual rates for the profits in my business and the wage, individuals are much more likely to be subject to something called the alternative minimum tax. And so from 1981 to 2015, with only a 1 year exception, I don't care how much in R&D credits that you qualify for. You could have $1 million in R&D credits. If you paid or were subject to the alternative minimum tax, you could use zero amount of that. You could use none of it. The R&D credit could not offset AMT, right? For companies under 50 now, so for 2016 forward, for companies under $50 million, so $50 million on average for the prior 3 years, your R&D credits can offset not only regular tax, but alternative minimum tax. For the companies on this call, on this webinar, this is a game changer. Right? This is the thing, and this will be the driver of tax savings for your company to the extent you qualify for permanent tax savings. Right? This is it. Okay. So just keep that in mind. So if you've looked at it and you said, well, gosh, I looked at it like 5 years ago and they just said it didn't work and I was doing basically the same thing I'm doing now, you need to relook at it. Okay. The other one that's had the most press lately is the Tax Cut and Jobs Act that was signed in 2017. So we're in the first year of that, right? So has there been any changes related to the R&D credit? Well, not specifically. It was largely untouched, honestly. The only thing that's different is that there has been an increase in the amount of credits that we can claim, net credits that we can claim. So whatever benefit or whatever change was really positive, and it hasn't been scaled back or anything like that. Okay. So I know we got 10 minutes. I wanted some times for some questions. The questions have come in. But I do have a couple of case studies that I just wanted to fill in some potential benefits for you claiming the credit. So let's go through that. So the first one, and I pulled case studies so I have a HVAC sheet metal design fabricator. So this company, they weren't doing HVAC work, but they were doing, when they would work, they weren't doing the install work, but they were doing the fabrication work and the design work around it. So they were fabricators. So they did some of the HVAC, like the duct work, looking at how it would be placed, the shapes, but also a lot of production work. So they were $12.7 million. They had a credit for 3 years of $280,000. Okay, so these are cash refunds, right? It's over $250,000 in refunds back in the pocket of the owner. Okay. Next, we have structural and miscellaneous steel fabricator. Yeah. So this one, they did detailing and estimating for steel structures. They did prototyping, 3D modeling. $23 million. They had a $180,000 tax credit. This study, I remember this one. was only a 2-year study that we went through. So we only looked at 2 years and generated that amount. And then lastly, we have, let me get to it, pardon me. Okay, a steel design fabrication company. So detailing steel structures, 31 million in revenue. They had over $400,000 in tax credits. These are federal credits. This company also had some state credits, but I didn't want to start to confuse the state incentive to give you an unreal expectation of the benefit, especially if your respective state doesn't have credits. Okay, so I have less time for questions. So if you guys have questions, I'm happy to answer any questions that might have come in. Bill, if you have any outstanding questions, I'll also put up, if you have any questions for me that you just maybe don't want to share with the group, but you want to ask me personally, I've included my email as well, that you're more than welcome. Shoot me an email. I will be more than happy to respond back to you with the answer or jump on a call. It doesn't cost you anything. I'm not going to bill you for my time, but I'm happy just to make sure we're putting you in the right direction in order to gain these incentives for you. Okay? Bill, I don't know how I did, but I'm
that was fantastic. It brings to light some of the things that there were some questions about. As we work with our customers, we're sometimes asked because there were prior tax relief for purchasing of capital equipment, things like that. And so we still get questions about that. Is that still able to be claimed? But now we have a new tool to talk to our customers about, to not only help us and our work for the customer, but also the customer's innate ability to draw down their tax and to receive those tax credits. So I'm thrilled. I'm going to be using this quite a bit to talk to our customers.
Yeah. And let me just point on that. I'm really glad that you brought that up, because as we talked about, a couple of different things, I think that's a really important topic that you brought up, is this concept of accelerated depreciation. So essentially, for all that of you on the line, I bought a piece of equipment, and I have the ability that, while it's a capital asset and subject to depreciation, either through bonus depreciation or Section 179, I can basically take the entire cost of that piece of equipment and write it off all in 1 year, right? And so that is intended to promote CapEx expenditures, which makes a lot of sense. Now, what's important to understand in that is that when we accelerate depreciation, those are only timing differences. I'm not getting any more depreciation by expensing it now versus if I expense it over the useful life. So what happens is that if I buy a bunch of equipment and all of a sudden I go, okay, I don't really need to buy any more equipment, and in future years I don't have any depreciation expense to offset my revenue, I'm inflating the tax. Okay, so the R&D credit, and one of the reasons it's so popular is the R&D credit is a permanent difference. There is no give back. I'm not foregoing something next year to claim it this year. Every year this will be available. So thank you for bringing that up, Bill. That was a really great point.
We do have a question from one of our attendees.
Yeah, we have a question from Anthony. He said, if our customer is paying us to help with the development of something, can we claim R&D, or is that theirs to claim?
Yeah, so we get this question a lot, is the concept of, okay, if we're being paid, so it's going to depend on how you bill for your services. Now, this is going to be very case specific, but I'm going to talk in a couple of generalities here. So typically, if we're quoting projects, so essentially it's an endeavor in which I say, I'll build you this for $10, okay? And it cost me $12 to build it, but I said it would only cost me 10 and I'm only able to charge 10, then I have economic risk related to that project, versus if I would bill on a time and material basis and say, okay, I'll build you this, and whatever it costs me in terms of time and whatever materials I use, I'll just bill you for that with a profit built in. Then your customer might have that economic risk, right? So that is in generalities. So if you're quoting a part for a customer and it's a quoted part, and either if you can't do it, you don't get paid, or if there's a cost overrun, you're going to eat it. Now, keep in mind that doesn't make it eligible or ineligible because that did or didn't happen, but it exists the possibility. That's when it's more likely to be eligible. And we would look at the purchase order. If there's a contract, we would want to have our attorneys look at it. But I would say directionally, that's the concept of the discussion we would have. Okay? Are there any other questions I can answer?
We don't see any other questions at this time, so we want to thank you, Greg and Bill, for being on this call and joining us today. As a reminder for the attendees, this webinar was recorded, and you will receive a link to it in an email within the next 24 to 48 hours. If you have any questions you think of after this, please feel free to email Sigmanest at sales@sigmanest.com or Greg Canard at gregcanard@alliantgroup.com.
Perfect. Thank you, Bill, for your time. Thank you, everyone at Sigmanest. Really appreciate it. And if there's anything that you guys need, don't hesitate to let me know, okay?
All right. Thank you.
Thanks very much.
All right. Bye-bye.